How does a bank that survived 2 world wars and the Great Depression disappear in a single weekend? Before dawn on a Monday in September 2008, we got our answer when its doors opened one last time and an employee walked out carrying a single cardboard box. By 9 that morning, dozens more had followed him. Nobody needed a headline to explain it. Lehman Brothers was gone, and before that week was over, Washington would be asked for hundreds of billions of dollars just to stop the same thing from happening to everyone else. To understand how one weekend could end a bank that old, we are not going to start with that Monday. We are going to start with the years that quietly built the machine that broke. Tonight, 3 things worth knowing. How ordinary borrowing quietly turned into extraordinary risk. Why one single weekend of meetings decided who would live and who would die. And what it actually cost the people who had nothing to do with any of it. We will tell it the way it was told at the time, as one bank's failure, one weekend's decisions. Then, at the end, we will separate what the record actually shows from what only makes a cleaner story. Robert, the keeper of the ledger, has sat at this desk through every chapter of this story so far. This is the chapter where he stops writing about one man or one country and starts writing about the whole machine at once. Our story's other desk is a deli counter on a Manhattan Avenue, run for close to 20 years by the same family, standing directly across the street from the glass tower we just watched empty out. The deli's owner pours coffee for the same bank employees every morning. His daughter, home from her first year of college, has started helping behind the counter and started listening a little too closely to what they say. The story really begins in 2001, after a recession and an attack that shook the whole city. To keep the economy moving, interest rates were cut again and again until borrowing money became remarkably cheap. Cheap money meant more people than ever could qualify for a mortgage, including many who, a few years earlier, never would have. At the deli, a regular customer, a construction worker, told the deli's owner he had just bought his first house. No money down. He said it felt like the easiest thing he had ever done. That loan did not stay with the small bank that made it. Within weeks, it was bundled together with thousands of others and sold up a chain all the way to Wall Street. On Wall Street, thousands of ordinary mortgages were sliced up and repackaged into new securities, then sold again to investors around the world, each one stamped safe by the agencies whose job it was to judge such things. The banks that bought and sold these bundles were also borrowing heavily to do it. For every $1 they actually owned, some had borrowed 30 more to bet with. A separate insurance giant was selling a different kind of protection, promising to cover the losses if any of these bundles ever went bad, collecting steady payments for a risk almost nobody believed would ever arrive. The deli owner's daughter, now studying finance at night, started asking the bank employees at the counter how it all actually worked. Their answers, she said later, were confident and vague. For years, the bet paid off. Home prices kept climbing, the bundles kept selling, and the profits kept growing. By 2006, few people on Wall Street wanted to ask what would happen if prices ever stopped. Then quietly, in late 2006, prices in some cities stopped climbing. In a few, they began to fall. Many of those easy loans had been built to reset to much higher payments after a few years. As home values fell, families who had borrowed the most began falling behind. In June and July of 2007, 2 large investment funds built almost entirely from these mortgage bundles collapsed. It was the first sign to anyone paying attention that the machine had a flaw. In August of 2007, the French bank BNP Paribas abruptly froze several of its own funds, admitting it could no longer even say what the mortgage bundles inside them were worth. Banks that had always lent each other money overnight, almost automatically, suddenly stopped trusting one another's paperwork. The whole system, built on that trust, began to seize. At the deli, the owner noticed his morning regulars getting quieter. Fewer jokes, longer silences over the newspaper. One bank in that tower across the street, Lehman Brothers, the fourth largest investment bank in the country, had leaned harder into mortgage bundles than almost anyone. Its chief executive was a man named Richard Fuld, who had built his career on refusing to back down. By early 2008, people had started calling it a credit crunch. Money that used to move easily between banks had simply stopped moving. The first serious tremor hit a smaller but storied investment bank named Bear Stearns in March of 2008, when word spread that it might not have enough cash to open its doors the next day. Overnight, the Federal Reserve arranged an emergency loan of nearly $13 billion, funneled through J.P. Morgan Chase, just to keep Bear Stearns open for one more day. Within days, Bear Stearns was sold to J.P. Morgan Chase for about $2 a share, a fraction of what it had been worth only a year before. The price was later raised, but the message was clear. Even a storied Wall Street name could vanish in a weekend. Across Wall Street, the lesson people drew was reassuring rather than alarming. When a bank got into real trouble, the government would find a way to catch it. Almost no one planned for what would happen if one day it didn't. Robert, the keeper of the ledger, has seen this pattern before. A warning arrives, is answered just well enough, and the deeper problem underneath it is never actually written down. The bank across the street from our deli had not slowed down. Even after the smaller bank's near collapse, it was still holding tens of billions of dollars in the very mortgage bundles that had started to sour. Outside, analysts began openly asking whether the bank's own books were telling the truth about what those mortgage bundles were really worth. Through the spring and early summer of 2008, the bank's stock price began a long, uneven slide, and every attempt to reassure investors seemed to work a little less than the one before. From behind his counter, the deli's owner didn't understand mortgage bundles or trading floors, but he understood that the men in suits ordering coffee were starting to look like men who hadn't slept. He didn't know it yet, but the easy part of this story was already over. That same summer, two enormous mortgage companies, Fannie Mae and Freddie Mac, which together backed nearly half of all home loans in the country, admitted they were running dangerously short of the money needed to cover their own guarantees. On the 7th of September, 2008, the government took direct control of both companies, an extraordinary step that barely made the front page compared to what was coming next. For Lehman, the takeover of those two mortgage giants knocked away the last thing the market had been leaning on. Investors turned their full attention to who might be next. Through the summer, Fuld had quietly been looking for outside investors willing to buy a large stake in his bank and calm the market's nerves. Korea Development Bank, a state-run Korean bank, offered about $6.40 a share for a large stake. Fuld, still convinced his bank was undervalued, held out for $17.50. By early September, those talks had collapsed entirely. Word of the failed deal leaked to the market within days, and the bank's stock fell harder than it ever had. The deli owner's daughter later said that week was the first time she saw a grown man in an expensive suit, visibly shaking while he waited for his coffee. In public, Fuld insisted the bank was solid, telling investors on a call that its capital position was strong. Privately, his own executives were already drafting contingency plans in case it wasn't. Robert underlines a single word in the ledger that week: confidence. Not money, not paper, confidence. The entire system, he seems to understand, was built on people believing it would hold. By the 10th of September, officials at the Treasury, the Federal Reserve, and the bank regulators in New York were watching Lehman's situation hour by hour, not day by day. On the 11th of September, the ratings agencies signaled they might downgrade the bank's credit, a move that would make it even harder to borrow the cash it desperately needed. That night, the deli's owner kept the shop open later than usual. Every light in the tower across the street was still on. He would say later that he didn't need to read a financial paper to know something was wrong. You could feel it in how fast people were walking. Late on the 11th of September, The Treasury Secretary, Henry Paulson, made a phone call that would define the entire weekend to come. He asked the heads of every major Wall Street firm to meet him the next evening. Before we go further, remember the promise. We are telling this the way it was told at the time. At the end of the episode, we come back and check every part of it against the record. Friday, the 12th of September 2008, began like any other morning at the deli. By that evening, it would become the first night of the most consequential 72 hours in modern Wall Street history. By mid-morning, unfamiliar black cars had begun pulling up outside a very different building downtown, the Federal Reserve Bank of New York. At 6 o'clock that evening, the chief executives of nearly every major bank on Wall Street sat down together in a single room on the 13th floor. Paulson told them plainly, one of their own was about to fail, and it was now their problem too, whether they liked it or not. Timothy Geithner, who ran the Federal Reserve Bank of New York, laid out the danger in blunt terms. If this bank failed with no plan in place, the damage could spread to every one of them. Fuld himself was not in that room. He stayed at his own office across town, working the phones, still hoping for a deal that would make the meeting unnecessary. At the deli, closed for the night, the deli owner's daughter walked past on her way home and noticed the tower across the street was still fully lit, well past midnight. By Saturday morning, the 13th of September, two separate efforts were underway inside that room, though almost no one outside it knew there were two. Robert draws two thin lines branching from a single point in the ledger. One path, he seems to know, leads to a rescue. The other leads nowhere at all. The first track involved a large British bank, interested in buying the whole firm outright, on one condition. The other Wall Street banks in the room would have to absorb a pool of its worst assets first. The other banks in the room resisted. None of them wanted to shoulder a stranger's bad debts, not when their own balance sheets were already under quiet strain. The second track was happening almost in secret. John Thane, who ran Merrill Lynch just a few blocks away, had begun to suspect his own firm might be next in line. Rather than wait to find out, he placed a quiet call to Kenneth Lewis, who ran Bank of America, one of the country's largest retail banks, based far from Wall Street. Thane offered to sell his entire firm, quietly, before anyone forced the question. Lewis, it turned out, was already listening. Back at the Federal Reserve, Paulson and the Fed's chairman, Ben Bernanke, kept pressing the room for a solution to the first bank's crisis, unaware a second quieter deal was already forming a few blocks away. By Saturday night, teams of lawyers on both tracks had begun drafting paperwork, one set for a rescue, one set, quietly, for a bankruptcy filing, in case neither deal came together. The deli's owner, who normally slept soundly, later admitted he kept waking up that Saturday night and looking out his own apartment window at the tower's lit floors. Sunday morning, the 14th of September, opened with cautious hope. Barclays' negotiating team signaled they were prepared to move forward with a deal, pending one final approval back home in London. Paulson placed an urgent call to his counterpart in London, the British Chancellor Alistair Darling, asking the British government to waive a rule that would normally take weeks to satisfy. Under British law, a deal of this size normally required a shareholder vote before a bank could guarantee another firm's obligations, a vote that would take weeks the market did not have. Darling and Britain's financial regulators declined to waive the rule. From their side of the ocean, it looked like being asked to import an American crisis onto British books overnight without proper safeguards. By early Sunday afternoon, word reached the Federal Reserve's 13th floor. The British deal was off. There would be no buyer for Lehman Brothers, the bank across the street from our deli. Paulson, Bernanke, and Geithner now faced a choice: lend the bank government money directly to keep it alive, or let it fail. They argued the bank had no viable buyer and, without one, no assets solid enough to legally back an emergency loan the way the smaller bank had months earlier. Others in the room believed that explanation was as much about avoiding blame as it was about the law. By Sunday evening, the decision was made. There would be no government rescue for this particular bank. It would be allowed to fail. That same Sunday evening, a few blocks away, Tain and Lewis finished their own negotiation. An all-stock deal worth roughly $50 billion, agreed in a single weekend. One bank found its lifeline that night. The other did not. Both decisions were made within an hour of each other, inside buildings less than a mile apart. Fuld received the news of his own bank's fate by phone, alone in his office, the room around him already emptying of its usual hum. Through the rest of that night, lawyers finished drafting the largest bankruptcy filing in American history for a firm that had survived the Civil War, 2 World Wars, and the Great Depression, but not this weekend. Robert closes one of the 2 forked lines he drew earlier in the ledger, leaving only the other open. He does not write down why. He only records that it happened. The deli's owner, closing up long after midnight, watched a line of town cars idling outside the tower across the street, headlights cutting through the dark. Inside, employees who had worked through the entire weekend were now being told, quietly, department by department, what tomorrow would bring. One young analyst, packing a single box of personal items early, called his family to say he still had a job, for now, but that everyone around him did not. As midnight approached, the filing was nearly ready. Once it was submitted, there would be no undoing it. At 1:45 in the morning on Monday, the 15th of September, the filing was submitted. Lehman Brothers, a bank with over $600 billion in assets, had just become the largest bankruptcy in American history. This is the moment we opened with tonight. The doors, the boxes, the cameras waiting in the dark before dawn. Now you know what happened in the 72 hours before it. The deli's owner opened his shop earlier than usual that Monday. He said later he simply couldn't sleep, and he suspected a lot of people across the street couldn't either. One of his regulars, a mid-level employee who had bought coffee at that counter nearly every morning for 6 years, walked past the window carrying his own box, not stopping to look in. The deli owner's daughter stepped outside with a free cup of coffee and simply held it out to him. He took it without a word and kept walking. When the stock market opened that morning, it fell hard within minutes and kept falling through the day, closing down about 500 points, its worst single day in years. It turned out Geithner's warning from Friday night had been correct. The failure did not stay contained. It began spreading almost immediately to firms that had nothing directly to do with the weekend's meetings. The very next day, AIG, the insurance giant that had spent years selling protection against exactly this kind of failure, discovered it could not actually cover the losses now landing on its own books. Unlike Lehman Brothers, officials decided AIG was too deeply woven into the entire financial system to be allowed to fail the same way. On the 16th of September, the Federal Reserve authorized an emergency loan of $85 billion to keep AIG alive, in exchange for nearly 80% ownership of the company. And here is the question that never really went away. How do you let one bank die on Monday and hand the next one $85 billion on Tuesday? Nobody in Washington had a clean answer then or since. That same week, the Reserve Primary Fund, a money market fund long considered as safe as cash itself, announced it could no longer promise investors a full dollar back for every dollar they had put in. Within days, investors across the country pulled hundreds of billions of dollars out of funds just like it, afraid the same thing could happen anywhere. The panic spread into a market almost no one outside finance had ever heard of. The short-term loans that ordinary companies rely on every week just to make payroll. The deli's owner had a small line of credit with his local bank, the kind he renewed every autumn without a second thought, to restock the shop before the holidays. That autumn, for the first time in nearly 20 years, the bank told him it could not renew the credit line, not because of anything he had done, but because the bank itself could no longer easily borrow the money to lend him. It was the clearest proof yet that this was never only a Wall Street story. The freeze that began in a boardroom on the 13th floor had reached a deli counter 3 miles away. Within the same week, two of the last remaining independent investment banks on Wall Street, Morgan Stanley and Goldman Sachs, applied to become ordinary bank holding companies overnight just to gain access to the kind of support that had saved Bear Stearns back in March. Days later, the largest savings bank failure in American history unfolded quietly when regulators seized Washington Mutual, a major thrift with over $300 billion in assets, and sold its banking operations to J.P. Morgan Chase overnight. Days after the bankruptcy, Barclays returned and bought the failed bank's American trading operations out of bankruptcy court for a fraction of what a full rescue deal would have cost that Sunday night. Robert draws line after line, branching out from that single closed fork in the ledger. The insurance giant, the money funds, the frozen loans, the failed savings bank, each one a separate entry, all traced back to the same single night. A week after the bankruptcy, the deli's owner noticed something else. Half his usual morning line was simply gone. Within a month, a for lease sign appeared in the window of a small shop, 2 doors down, one that had depended on the same morning foot traffic he did. By late September, officials in Washington understood that letting the crisis simply run its course was no longer an option. Paulson began drafting the largest financial rescue plan in American history. The plan asked Congress for $700 billion in emergency authority to buy troubled assets from banks across the country, a number so large that even seasoned lawmakers reportedly sat in stunned silence when they first heard it. Outside the Capitol, and at deli counters and dinner tables across the country, the reaction was immediate anger. Why should ordinary taxpayers rescue the very banks whose bets had caused the crisis in the first place? At the deli counter, regulars argued about it over coffee every morning that week. The deli's owner mostly listened. His own line of credit had just been pulled by a bank his tax dollars might now be asked to save. Within days, that same argument would move to a vote in Congress, and almost nobody expected what was about to happen there. On the 29th of September, the rescue plan came to a vote in the House of Representatives. Most observers assumed it would pass. It did not. The bill was voted down, 228 against to 205 in favor. Markets were watching the vote live, and they did not wait for an explanation. By the closing bell, the stock market had fallen by 777 points, wiping out well over $1 trillion in value in a single afternoon. At that time, the single largest point drop the market had ever recorded. At the deli owner's daughter watched the vote and the crash unfold together on the small television behind the counter, her notebook of finance homework forgotten beside the register. Within days, lawmakers returned to negotiate a revised version of the bill, adding new safeguards and raising the insurance limit on ordinary bank deposits to reassure a frightened public. That single change mattered enormously to people like the deli's owner, whose entire life savings sat in one ordinary bank account, insured only up to a certain limit. On the 3rd of October, the revised bill passed both chambers of Congress and was signed into law, creating the $700 billion Troubled Asset Relief Program, known as TARP, to buy troubled assets and stabilize the banking system. The new program did not instantly fix anything. Banks remained nervous. Lending stayed tight for months. But the outright panic of that single September week began slowly to ease. Rather than only buying troubled assets, officials soon decided the fastest way to stabilize the banks was to buy shares directly in them, making the government, for a time, a part owner of some of the largest banks in the country. Even as the immediate panic eased, the wider economy kept sliding. Over the following year, millions of Americans lost their jobs, and hundreds of thousands lost their homes to foreclosure. One of the deli owner's own regulars, the construction worker who had bought his first house so easily back in 2003, lost it to foreclosure that winter. The single house key he had proudly shown off at the deli counter years earlier was handed quietly to a bank representative on his porch that winter. Robert draws a single small house shape in the margin of the ledger, beside the long list of banks and billions. It is the smallest entry on the page, and somehow the heaviest. In the years that followed, one phrase from that single September weekend outlived almost everything else: too big to fail. It became the question at the center of every debate about how the whole system should be rebuilt. Congress eventually passed a sweeping set of new financial rules meant to make banks hold more of their own money in reserve and give regulators new power to wind down a failing bank without another chaotic weekend. Whether those new rules were strong enough, or whether the largest banks simply grew larger still in the years that followed, remains one of the most argued questions in modern finance. A year after that September weekend, the tower across the street had a new name on its lobby directory. The deli, remarkably, was still open. Some of the old regulars never came back. New ones from new companies slowly took their place at the counter. The deli owner's daughter finished her finance degree that year. She later said the weekend across the street was the reason she chose to work at a small community bank instead of a Wall Street firm. The deli's owner kept one thing from that autumn taped quietly behind the register: a single newspaper photograph of the boxes coming out of the tower, a reminder, he said, of how fast things can change. Robert closes this chapter of the ledger, drawing one final line beneath the long list of names and numbers. Before we close it with him, remember the promise we made at the start of the hour. It's time to separate what actually happened that weekend from the version that has hardened into legend in the years since. Here is where the popular version cuts a corner. People remember this as a story about one weekend. It was not. That weekend was a bill coming due on nearly a decade of cheap borrowing, bundled mortgages, and leverage nobody had bothered to stress test. The official line is that there was simply no legal way to save Lehman. No buyer, no collateral clean enough for an emergency loan. Maybe. Plenty of people who were in that room, and plenty of historians since, think that explanation does a lot of work to cover for a judgment call made by exhausted people under impossible pressure. You will still hear it said that everyone on Wall Street got bailed out that year. One firm did not. Lehman Brothers is still, to this day, the largest bankruptcy in American history, and no government check ever arrived to stop it. It is tempting to blame the British for killing that deal out of pure stubbornness. That is not quite fair. They were enforcing a real law that genuinely could not be waived in an afternoon, even if the phone call asking them to try was about as tense as a phone call gets. Ask most people what happened to that $700 billion, and they will tell you it vanished into Wall Street's pocket. Most of it actually came back with interest, and parts of the program turned a profit for the government. The housing side of it is a different, far less flattering story. It makes a satisfying story. One stubborn man's pride sank a 150-year-old bank. Fooled, really did turn down a lower offer he probably should have taken. He also did not invent the industry-wide leverage, the accounting pressure, or the market-wide panic. And none of that disappears from the story just because one man makes a better villain. And if you think this is a closed chapter, go find the nearest argument about which banks are too big to fail. It never actually ended in 2008. It just changed rooms. Robert turns back through the ledger's older pages one more time. A boy's white paper, a stubborn banker's ransom demand, a currency trader's bet, a king's paper money. Each chapter this series has told so far. Every chapter he has recorded has been, underneath its details, the same lesson. A system built on trust can hold for a remarkably long time, right up until the moment it doesn't. He turns forward again to a fresh blank page at the very back of the book and dips his pen. He writes a single line, unhurried, the same way he has closed every chapter before this one. He closes the ledger gently. the gold coin still resting on its cover, and sits back, unhurried, watchful, waiting for whatever chapter comes next. For just a moment, he looks directly toward you, the only time in this entire hour that he does, not to speak, only to be seen, before turning back to the candle. If you had been standing behind that deli counter that September, watching both sides of the street at once, which decision from that weekend would you have made differently? Tell us in the comments. We read everyone. We keep making this series because moments like this weekend get simplified into a single villain or a single headline awfully fast. The full ledger is almost always more complicated and more human than the legend. A quick note. This episode is a work of historical education and storytelling, built from public record, congressional testimony, and financial history. It is not financial advice, and nothing here should be read as a recommendation about any bank, investment, or company operating today. One weekend of meetings in a single building on Wall Street came remarkably close to freezing the entire modern financial system all at once. Paychecks, mortgages, and small business loans included. Next time, this series goes back 70 years earlier to a chapter about a very different kind of attack on money. Not a collapse this time, but a deliberate plot to destroy an enemy's currency from the inside, using counterfeit banknotes made by prisoners in a Nazi camp. Back on the avenue, the deli's owner raises his shutter for another ordinary morning, the tower across the street catching the same early light it always has. His daughter pours the first coffee of the day and passes it across the counter. The same simple exchange this street has seen every single morning, through every single thing that happened across from it. Money and Power, Hidden History. Season 2, Episode 4.